Our outlook for 22 and even beyond has changed fairly materially in light of the events in Russia and Ukraine. We were already preparing for an economic slowdown in the second quarter, really driven by a decline in fiscal spending of about 1.3 trillion in 22, the bulk of which hits the second quarter. And we're also preparing for a slowdown in inflationary pressures. The events in Ukraine do a couple of things. One, it brings the geopolitical rivalry that's been in the background between the US, Russia, and China to the foreground. It also is going to exacerbate the slowdown and keep inflationary pressures a little bit more elevated in the first half of 22. We still expect inflationary pressures to continue to decline. Inflation will remain elevated, but it will decline. The economic slowdown is going to be a little bit more abrupt, and we're starting to see that in the yield curve as it flattens out. And the most important thing for investors is not to be caught with a lack of imagination. The geopolitical rivalry is going to intensify. The U.S. has previously weaponized the dollar system. We're now witnessing Russia weaponize the commodity markets and the commodity cycles. And we're going to see China play games with the supply chains. All of these things mean an acceleration in deglobalization, further margin pressures, and a rising cost of capital. We came into 22 thinking that in the initial part of 22, in the first quarter, energy markets would be relatively balanced and then would go into a situation of very tight supply in the back half of 22. The events in Russia and Ukraine only exacerbate that. The policy choices we're witnessing out of government officials, including suspending gas taxes, providing subsidies, or releasing the SPR, are only going to exaggerate energy prices to the upside throughout the cycle. So these are not supportive to balancing energy markets in general. That said, if we probably have seen the potential peak in oil prices already this year, unless we lose key infrastructure in Ukraine, those key pipelines that cross Ukraine, or Russia is forced to shut in production because of oil embargoes that create a backup in their infrastructure. Either one of those two situations occur, and we could see a super spike in oil prices that would have very deleterious impact on the global economy. So in general, elevated energy prices, they're not going to retreat significantly from here. The current oil prices around $100 Brent are not reflected in energy markets currently, but investors need to be very cautious. I wouldn't focus on sectors. You need to pick out what securities you want to own on the other side of these pressures we're feeling. And it's not going to be broad growth. It needs to be tailored to individual securities and individual sectors. We're going to see volatility rise through the second quarter. We're going to see a drawdown in equities as the U.S. Federal Reserve begins to shrink its balance sheet. And that's going to give investors an opportunity. One area globally that has been hit incredibly hard are European small and mid-cap stocks, and justifiably so. It's very possible that the European area could experience a recession in the back half of this year. That said, one of the key anchors in capital markets has been the negative yields in European bonds. Those have lifted. That has raised the cost of capital broadly, but more importantly, negative yields in Europe have favored the US dollar for a number of years, and you've seen two years plus of pressure on the euro. So as we move through these near-term concerns, as we begin to discount the economic slowdown in Europe, you may find a tailwind over the intermediate term in these European small and mid-cap securities, not only from rising from oversold levels, but potentially the euro catching up and a weakness in the dollar.